Welcome back to the deep dive. We're here to cut through the noise and really get you the essential insights you need on the global economy.
And today, we're tackling something pretty fascinating, I think. It's the story of how Chinese tech firms are, well, rapidly taking over in consumer electronics worldwide.
Exactly. And we're going to use a specific market as our lens, right? Home cleaning robots, robot vacuums, mops, that kind of thing.
Yeah, it's a perfect case study. Really compressed. It shows their strategic agility. If you want to understand how companies like Xiaomi or DJI or maybe EcoFlow are just conquering global markets.
You look at the robot cleaner.
You look right there. It's like, we're calling it Aladdin's global adventure. It's just this dizzying speed. They're generating international wealth, influence. It's quite something.
It really is. So our mission today isn't just to point out that they're dominating. We want to get into the how and the why.
The mechanics underneath it all.
Yeah, we're analyzing the strategies. The key players here are folks like Stone, Ecovacs, Dream, and Xiaomi. I mean, they've basically rewritten the rule book for consumer tech competition.
Let's kick off with some hard numbers just to set the scene. If you look at Q1 2025, globally, the robot cleaner market shipped over 5 million units.
5 million in one quarter.
Yeah, and that was about 12% year-over-year growth. Pretty solid. But here's the kicker. The combined global market share of just those four big Chinese players we mentioned.
Stone, Ecovacs, Dream, Xiaomi.
Already over 50%.
Wow, more than half the market.
They've crossed that threshold. They're not just strong players anymore. They're kind of the gatekeepers now. And this happened incredibly fast, just in the last few years.
Okay, controlling half the global volume, that's a powerful spot to be in. So as we're looking back at the first half of 2025, should we note anything else? Like, is the growth steady everywhere?
Well, that's the thing. It's not uniform. We saw that strong 12% in Q1, but then things cooled off a bit in Q2. Growth was more like around 10% globally.
Okay, it's a slight slowdown.
It is, but you got to put that Q2 number in context.
Yeah.
Historically, this sector really ramps up in the second half of the year.
The holiday season effect, Black Friday, all that.
Exactly. All the big retail seasons. So our sources are pretty clear. Future growth is really weighted towards H2. They expect it to account for like a massive 60% of the whole year's shipments.
60% in back half. Okay.
So that 10% in Q2 is probably less about long-term stagnation and more like maybe a strategic pause before the big volume push really kicks off later in the year.
Okay, let's unpack that slowdown a bit more, and also the differences we're seeing between regions, especially when you factor in, geopolitics. It feels like all that friction we read about must be impacting where these companies sell, right?
Oh, absolutely. It translates directly into market dynamics. You look at the growth forecasts for the second half of 2025, H2, and the picture is really fragmented.
How so?
Well, APAC, Asia Pacific, that market's projected to really soar. Growth around 15%. You've got a rising middle class there, favorable trade. It's looking good.
Okay, 15% in APAC. What about Europe?
Europe's more stable. Expected growth is around, say, 11%. Still decent.
But North America, that's a huge market, usually high value. You said it's lagging.
Lagging significantly. That's where the geopolitics really bites.
Why is the world's biggest economy seeing slower growth here? Is it just saturation?
It's the tariffs, the direct consequence of the new U.S. tariffs. They're specifically set at 20% on these kinds of products, and that's a major constraint.
Okay. So what does that do to the growth forecast?
Our sources project North America's H2 growth rate will only be around 9%.
9% compared to 15% in APAC. That's a big difference.
It's a 6 percentage point gap in growth velocity. That's huge. It means R&D money, sales focus. It starts shifting away from the U.S. market.
9% is still growth, not shrinkage. But yeah, that gap is telling. It really shows the cost of that economic friction. So the tariffs hit. The big question is always, who actually pays for it? Does the company eat the cost, or does it get passed on to me, the consumer?
It gets spread around, but yeah, the consumer definitely feels it. Maybe not in the way you'd expect, though.
How do you mean?
The immediate hit from the tariffs is about a 4 percentage point reduction in the gross margin for these robot cleaners coming into the U.S. That 4% has to go somewhere.
Okay, so if a company like Stone suddenly makes 4% less profit margin on each robot sold in the U.S., how does that cost get split up? Who absorbs what?
The estimates are pretty specific. Consumers. They end up absorbing the biggest chunk, somewhere between 40 and 50% of that hit. So roughly 2 percentage points of that margin loss.
2 percentage points. But you said it's sneaky. How does that show up for the buyer? It's not like the sticker price jumps overnight, usually.
Exactly. It rarely shows up as a higher list price. What happens is those big promotional discounts you wait for, they shrink.
Okay, walk me through an example. Say I'm eyeing a $700 robot cleaner.
Right. Before the tariffs, maybe you'd see a big holiday sale, like 30% off. Takes it down to, what, $490? Pretty good deal.
Yeah, it makes a difference.
Okay, now, with the tariff pressure squeezing their margins, the manufacturer just doesn't have the wiggle room for that deep 30% cut anymore. So that 2 percentage points the consumer absorbs, it means that big, flashy 20–30% off discount, it gets slashed. Maybe now it's only 5% or 10% off.
So I still buy it, maybe, but I end up paying a lot closer to the original price. I've essentially paid for part of the tariff without realizing it.
You got it. It feels like just a worse sale this year. Meanwhile, the manufacturers themselves, like Stone, they eat about 40% of that 4-point hit. And the retailers, the channel partners, they absorb the last 20%.
Fascinating. It's hidden in the discount. Okay, so given this reality, and North America is still a massive market, they can't just swallow that margin hit forever. What are these Chinese firms doing strategically to fight back, to keep their margins and keep selling to U.S. consumers?
Their response is classic. Textbook strategic agility, really. Rapid supply chain diversification. This is absolutely key to understanding why they often outmaneuver legacy players.
Diversification how? Moving factories.
Exactly. Leading firms. Stone is a prime example here. They're tactically offsetting the tariffs by shifting where they make the products. Our sources say Stone specifically started making its mid to low-end robots in Southeast Asia, specifically Vietnam, back in late 2024.
Okay, Vietnam. So that avoids the U.S. tariff on goods from China. But wait, if Stone can just shift production to Vietnam for its cheaper models, why can't an American company like iRobot do the same thing just as easily for all its products? What's Stone's edge here?
That's the crucial question, isn't it? Stone's advantage is its deep, deep integration within that incredibly flexible Chinese manufacturing ecosystem. Even if the final assembly plant moves to Vietnam.
The parts still come from China.
A lot of them, yeah. The batteries, the motors, the specialized plastic molds, the sensors, that whole supply chain is still largely centered in China, and it's incredibly adaptable and cost-effective. Stone keeps tight control over that critical component base.
So they just move the last step.
Pretty much. For a company like iRobot, which might rely on more rigid, maybe slower Western supply chains, trying to replicate that kind of nimble shift is way more complex, way more expensive. Stone's move is more of a tactical adjustment than a complete supply chain overhaul. It speaks volumes about their speed.
Okay, that speed and flexibility make a lot of sense. And that brings us right to the heart of it. Strategy. Let's contrast these big four Chinese players. They're all gaining share, but they're not all doing it the same way, are they?
Not at all. Different playbooks. Let's start with Stone. They're the current leader in global shipment volume.
How are they staying on top?
Pure aggressive channel development, just getting the product everywhere. In North America, that means striking big deals with major physical retailers. Think Target, Best Buy. Getting on those shelves so people see them.
Makes sense. Visibility.
But their move in Europe is maybe even bolder. They're actually shifting away from using third-party distributors and moving towards direct operations.
Direct operations. That's got to be expensive upfront, right? Setting up your own sales teams, logistics.
It is expensive initially, but it gives Stone total control. Control over pricing, branding, and crucially, the entire margin stack. They cut out the middleman.
So they protect their profitability long term.
Exactly. Stone is the volume player, the logistics powerhouse. They want maximum global reach and total channel control.
Okay, so that's Stone. What about Ecovacs? They've been around a while, kind of the established Chinese player in this space.
Right. Ecovacs, they're more the diversifier. They're seeing solid growth overseas, maybe 15–20% in Q1. Pretty healthy.
How does their strategy look different from Stone's big volume push?
Ecovacs relies on a much broader product lineup. They're not just selling robot vacuums. They have other established home appliance categories.
Ah, so they have cushions? If one market dips, others might hold up?
Precisely. It gives them stability through breadth. They're maybe a bit more resilient to sudden shifts in just the cleaning robot market compared to a company focused only on that.
Okay, then there's Xiaomi. They're a whole different animal, right? A massive ecosystem company.
Yeah, Xiaomi is the ultimate ecosystem player. In robot cleaners, their growth is steady, but it can be variable sources, say around 15–25% in the first half of the year.
And their strategy is tied into everything else they sell.
Deeply integrated. They heavily rely on people already buying into their huge smart home platform. They push their low to mid-range robot cleaners as just another piece that fits seamlessly into that Xiaomi ecosystem.
So they're not necessarily trying to make the highest profit on the robot itself.
Probably not. They're chasing customer lock-in, the stickiness of the whole ecosystem. It's very similar to how they approach the smartphone market, actually. Get you in the door with one product, then sell you others.
Right. And finally, Dream. You called them the high-margin disruptor. This one sounds like the blueprint for the future, maybe. Aggressive growth, but smart about profits.
Dream is, yeah. Surgical expansions may be a good way to put it. Their growth is just explosive. In Q2, their growth rates were apparently 10 to 15 percentage points higher than even Stone's.
Whoa, significantly faster.
It's fueled by this really clear, almost relentless focus. Dominate the high-end market. We're talking the $800 plus segment for these robots.
Okay, let's dig into that. Why focus only on the most expensive models?
Yeah.
Why is that the key to their global strategy and maybe the template for others like DJI or Bamboo in different tech areas?
It comes down to, I think, three main advantages, and it all centers on generating capital and reinvesting it incredibly quickly. So first, profitability.
The margins must be way better up there.
Exponentially higher. Dream's gross margins on their core cleaning products are already really good, like 50–55%. But in that highest end segment, they can hit a stunning 60 to 70%.
60 to 70% gross margin. So for every $1,000 robot they sell, they're banking $600 to $700 in gross profit.
Exactly. That's cash available for reinvestment. Now compare that to the low end of the market.
Which we'll get to later with iRobot, operating maybe around 30% margin.
Right. Dream is generating potentially twice as much raw capital per unit sold compared to a low-end competitor. This surplus cash is their engine. It lets them constantly fund the R&D arms race, pay for big marketing campaigns in new countries, cover the costs of building those offline sales channels.
Becomes a self-funding cycle of innovation and expansion.
Precisely. The high-end focus fuels itself.
Okay, profitability. What's the second advantage?
Resilience. Think about who buys a $1,000 robot vacuum.
Higher income consumers?
Generally, yes. And those consumers are significantly less sensitive to macroeconomic bumps in the road or trends like consumption downgrading. If the economy gets a bit shaky, they might delay buying a new car, sure. But they're probably still buying the premium version of a convenience appliance like this.
So their revenue stream is more stable, less affected by downturns compared to companies relying on budget buyers.
Exactly. It provides profit stability that the low-end guys just can't count on.
Makes sense. And the third advantage, market leadership. Does focusing high-end actually help them dominate the whole category?
It absolutely does. And that's the third point. Dream is already proving this out in certain premium markets. Take Germany, for example. Our sources suggest Dream's volume in that over $800 segment can actually surpass Stone's volume in that same top tier.
Even though Stone is the overall volume leader globally.
Yeah. By focusing their best tech and features on those highest margin customers, they build this brand premium, this perception of technology leadership. And that halo effect kind of trickles down, reinforcing their whole market position.
Okay, this relentless drive for high margins plus the super fast iteration. It sounds like a winning formula. But now there's a huge new challenger stepping into the ring, DJI, the drone company.
There's the DJI effect. And yeah, it's potentially a massive game changer. DJI, world famous for their drone tech, right? They've jumped into the cleaning robot market. They launched their high-end Romo machine.
Romo. And what's the price point?
Overseas, it's landing right in that competitive $700, $800 USD range.
So not starting at the bottom, they're going straight after that premium segment Dream and Stone are fighting over.
Head on. They aren't just dipping their toe in. They are immediately challenging the high-margin incumbents.
What makes DJI such a big threat here? I mean, beyond just being a huge tech company with deep pockets.
It's their core tech advantage. The technology from their drones is perfectly directly transferable to high-end robot cleaners.
How so? What specifically?
Think about what a sophisticated drone needs to do. Advanced 3D mapping of complex changing environments, precise navigation down to millimeters, and maybe most importantly, coordinating multiple machines like drone swarms.
Ah, I see. Those are exactly the skills you need to take robot cleaning to the next level, beyond just bumping around.
Precisely. Moving from just automated movement to real spatial intelligence. The Romo brings advanced sensor fusion, sophisticated mapping. Stuff DJI has spent over a decade perfecting for drones. It instantly raises the bar for the whole industry.
And there's another huge advantage DJI has, right? They didn't have to build their sales network from scratch like Dream or Stone did.
That's the other killer advantage. Their existing global channel power. DJI already has this incredibly robust network. Over 4,000 stores just in China, plus a strong presence in over 100 countries worldwide.
So they can get the Romo onto shelves globally almost overnight.
Pretty much.
Hmm.
It gives them immediate market presence and distribution scale. They completely bypass those years of painstaking channel buildup their competitors had to go through. It's a massive scaling shortcut.
Okay, so DJI swooping in, it's great for pushing innovation faster, I guess, but it must put serious pressure on those juicy high margins that Stone and Dream have been enjoying.
Oh, absolutely. It significantly ramps up the competition in that premium segment. It forces everyone else to innovate even faster. And yeah, it could potentially start to compress those 60–70% margins we talked about.
But maybe it grows the whole pie.
That's the upside. It also validates the entire high-end strategy. DJI's entry is expected to actually grow the size of that premium over $800 segment, maybe from its current 3–4% of total market volume up to something like 6–8%.
So DJI legitimizes and accelerates the shift towards premium features.
You got it. More competition, but also a bigger, more valuable market segment overall.
This intense pressure, everyone trying to out-innovate each other, it leads directly to something our sources mentioned, this technology leveling phenomenon. If DJI introduces some breakthrough tech, how long does that advantage actually last?
Not very long at all. That's the reality. Technology leveling basically means that the core functional techs, the really important stuff among the top players like Stone, Ecovacs, and Dream, tends to equalize very quickly.
How quickly are we talking?
Often within just 6 to 12 months. If Dream launches, say, a fancy new integrated self-cleaning mop system,
Stone and Ecovacs will have something similar within a year.
probably. They have the R&D budgets, they have that flexible supply chain we talked about, and the operational speed to match it pretty fast. The real challenge isn't just creating the innovation, it's maintaining any kind of lead for a meaningful amount of time.
So if the basic technology keeps plateauing so fast, where's the next big fight? What's the sustainable competitive advantage they're all chasing now?
It seems to be shifting towards two main areas: AI perception and functional integration.
Okay, AI perception. What does that mean in practice? Smarter robots.
Much smarter. We're seeing companies like Dream investing in specialized hardware now. Things like dedicated 10T processing chips.
10T. What does that kind of processing power actually let the robot do differently in my house?
It's the difference between just basic object avoidance and, like, true contextual understanding. An older robot might just see a fuzzy brown blob on the floor and avoid it.
Right. Could be anything.
A robot with a 10T chip can use way more data spatial info, texture recognition, learned patterns to figure out if that blob is a coiled up power cord,
Yeah.
or maybe a pet accident, or tell the difference between a drop sock and a kid's Lego brick.
Ah, okay. That massively improves reliability. Makes the robot actually autonomous instead of needing me to prep the room constantly. Less user frustration.
Exactly. That's the goal of better AI perception.
And the second frontier, functional integration. Sounds like making the robot do more by itself.
Yeah. The big push across the industry is towards systems that are fully automatic.
Yeah.
Self-cleaning brushes, self-emptying dustbins, docking stations that automatically refill clean water and empty dirty water.
The dream of a robot that can just run for weeks without me touching it.
That's the target. But here's where we see this really interesting split between the market in China and markets overseas.
Oh, how so? What's the difference in features?
In China, that kind of full automation, the auto water and waste disposal, it's becoming expected. It already has something like 30–50% market penetration. It's almost a standard feature on higher-end models.
But not elsewhere.
Overseas, it's still developing much more slowly. It's a bigger hurdle. You need to think about integrating with home plumbing, different floor plans, just consumer willingness to adopt that level of appliance integration. It's complex.
So a challenge, but also a huge opportunity for whichever company cracks that nut overseas, makes it easy and appealing.
Immense opportunity, yeah. Whoever figures out the localization and the ease of use for those fully automated systems outside China could really dominate.
Okay, let's zoom out a bit. We've been focused on the cleaning robots themselves, but we need to talk about the bigger picture, the broader ambition driving these companies. This isn't just about selling one-hit product, is it? Let's use Dream's boundless ecosystem idea as an example.
Right, this is the strategic long game. These firms, especially the ambitious ones like Dream, they're absolutely not content just being niche cleaning appliance specialists forever.
What's the bigger goal then?
Dream's explicit long-term goal: to grow into a huge, diversified global home appliance group. Think Medea or Hair, those established Chinese giants.
Okay.
They want to be on that scale.
So they're using the profits and the R&D know-how gained from dominating the high-margin robot market to fuel a much broader expansion.
Exactly. Leveraging that initial success.
And this diversification isn't just talk, right? They're actually launching products in totally new categories.
Oh, yeah, and rapidly. They're aggressively pushing into things like high-speed hair dryers competing with Dyson there, water purifiers, even large white goods refrigerators, washing machines.
Wow, big appliances. That's a major step.
Huge step. And they're also chasing those really high-growth, cutting-edge segments, like robotic lawnmowers. That market apparently grew something like 50% in 2024 alone.
50% growth. Incredible.
So they're targeting any high-potential market where they think their core tech in things like electric motors, battery management, navigation can give them an edge.
That kind of speed, that scale of investment across so many different categories, it takes serious capital. And our sources pointed out a really interesting, maybe underappreciated advantage Dream has over rivals like Stone or Ecovacs.
The private company edge, yes.
Explain that. How does being unlisted help them move so fast?
It gives them tremendous strategic flexibility, especially in how they deploy their capital. Flexibility that a publicly traded company answering to shareholders every quarter simply doesn't have.
Public companies need consistent, positive quarterly results, or the stock gets punished.
Right. Dream, being private, can strategically decide to take a short-term financial hit if it serves a long-term goal. They don't have that same immediate pressure from the stock market.
Can you give a concrete example? Like, how did this play out recently, say, with their Q3 2025 revenues?
Sure. So for the second half of 2025, Dream apparently made a deliberate, planned decision to cut back significantly on their online advertising spending within China.
Okay, saving money on ads. What was the immediate result?
The immediate result was a projected drop in their domestic online revenue for Q3, somewhere between 30 and 60%.
30 to 60% drop. If a public company like Stone announced that kind of plunge in a key market.
Their stock price would absolutely crater overnight. Shareholders would panic. But Dream, being private, they're immune to that quarterly pressure cooker.
So they took the revenue hit, but where did the money they saved on those online ads go? What was the strategic trade-off?
It was aggressively reinvested, poured directly into the slow, expensive, long payoff process of building out offline sales channels, physical stores, retail partnerships for all those new product categories.
The white goods, the water purifiers, the hair dryers.
Exactly. They used their private status to make a strategic capital shift. They prioritized building the foundation for future, diversified growth over maximizing current online sales, knowing it would look bad on paper for a quarter or two. That's a maneuver that's almost impossible for their publicly listed competitors to pull off.
That level of capital agility is really impressive. And they've also been smart about managing cash flow internationally, right? Another capital efficiency play.
Yeah, this is another key innovation. Their financial distributor, or FD, model for overseas markets.
Financial distributor, what does that mean?
Basically, in their overseas strategy, Dream partners with these FDs.
Yeah.
And these partners take on some really crucial financial burdens that usually tie up a manufacturer's own cash.
Like what burdens do the FDs take?
Most importantly, warehousing costs and inventory funding.
Ah, so the distributor pays to store the products overseas, and they actually fund the inventory. They pay Dream for the goods before they're even sold to the end retailer or consumer.
Essentially, yes. The FD carries a lot of that inventory risk and the working capital needed for those large, expensive shipments sitting in warehouses waiting to be sold.
So Dream gets paid faster and doesn't have its own cash tied up in unsold inventory sitting thousands of miles away.
Exactly. It means Dream can operate with much, much leaner internal capital requirements for global distribution. They free up their own cash.
And where does that freed up cash go?
Back into their core strengths, R&D, innovation, maybe more direct consumer marketing. It maximizes their capital efficiency, drastically speeds up how quickly they can launch new, diversified products globally, and ultimately boosts their overall profit margins because they've optimized their internal cost structure, not just slashed the product price. It's very clever.
Okay, so you have this combination. Strategic agility, high-margin products fueling reinvestment, flexible private capital, smart channel innovations. It brings us to the inevitable question. What happens to the established legacy brands, especially the American ones, when they face this kind of competitor? Let's use iRobot, the U.S. company, as the case study here. Seems like a cautionary tale.
iRobot is probably the clearest example of what we call the profit trap. Their traditional, long-standing focus has been on the lower end of the market, the $200, $300 robot cleaners.
Okay. And the problem with that?
It's created a fundamentally unsustainable financial model for them in today's environment. Our sources indicate iRobot's gross margins down in that segment are really low, maybe hovering around just 30%.
30%. We already contrasted that with Dream hitting maybe 60, 70% on their high-end stuff. That's a massive gap.
It's a crushing disadvantage. That thin 30% margin simply doesn't generate enough surplus cash. Not nearly enough to fund the relentless high-speed R&D you need to compete when technology is leveling so quickly.
So they're constantly behind the curve on innovation because they just don't have the R&D budget.
They're chronically undercapitalized for innovation. It means they're always playing catch-up, technologically speaking. And that's just a losing battle against these high-margin Chinese titans who can afford to outspend and out-innovate them consistently.
Now, iRobot did try something recently, right? They tried cutting prices pretty deeply, sometimes up to 20%, to try and boost sales volume. How did the big Chinese players respond to that move? Did they match the price cuts?
Nope. They refuse to follow iRobot down that path. And this really shows the strategic discipline of these companies. They recognize that chasing volume at the low end is just a race to the bottom. It destroys the very profit margins they need for their long-term diversification and R&D plans.
So instead of cutting prices?
They held their profitable price points, focused on their superior features, and just aggressively went after the market share that iRobot was effectively giving up in key markets like Europe and North America by trying to compete solely on price.
They're basically letting iRobot burn through its cash reserves, trying to defend an indefensible low-margin position.
That seems to be the strategy, yeah.
Right.
Wait them out while capturing the more profitable segments.
Okay, so this pattern, the rapid tech iteration, the focus on high margins, the flexible capital, it's clearly not just about robot cleaners. This feels like the new playbook for how Chinese consumer electronics companies are achieving dominance across many different sectors globally.
It really is the defining characteristic of the competitive landscape right now.
Okay.
You see the exact same dynamics driving success for DJI in drones,
Right.
for Xiaomi, Oppo, Vivo in the global smartphone market.
Taking huge share there, too.
Yeah. And for newer, fast-growing companies like EcoFlow in portable power stations or Bamboo Lab in high-speed 3D printing, the core elements are consistent.
Can you list those core elements again? What defines this winning model?
Sure. It's 1, rapid technological iteration and equalization. 2, a ruthless focus on achieving high margins and then efficiently reinvesting those profits. 3, strategic adaptation of supply chains and sales channels, like the Vietnam move for tariffs or that FD model for capital efficiency. And 4, aggressive, diversified expansion into new categories, often fueled by the speed and flexibility that private capital allows.
So the takeaway is they're not just winning because they're cheap anymore. That's the old story. They're winning now because they have a superior organizational structure, one that enables incredible speed, deep profitability, and unprecedented capital agility.
That's the absolute essential insight, I think. They've fundamentally shifted the game. It's not just a price war anymore. It's a war of operational efficiency, R&D speed, and strategic capital deployment.
And this structure makes it really hard for the traditional Western or maybe established Japanese manufacturing giants to compete effectively.
Extremely difficult. Those legacy models often operate on slower, more consensus-driven R&D cycles, maybe rely on thinner margins spread across rigid product lines, and they're always dealing with the tyranny of quarterly reporting to public markets. They seem structurally disadvantaged in this new high-velocity environment.
Okay, that brings us towards our final synthesis then. This deep dive has really shown, I think, that the new global standard for success in consumer electronics isn't just about optimizing a factory anymore. It's about this relentless combination of high-speed tech delivery, capturing high margins, and then having the strategic agility to deploy that capital across a diverse global portfolio.
Yeah, and the traditional Western or Japanese model, which often looks like slower iteration, maybe thinner margins, more rigid product lines, and that constant short-term focus driven by public markets, it just seems ill-equipped structurally to keep pace.
So the provocative thought we want to leave you, the listener, with today is this. If this new model, this relentless, profit-driven, fast-iterating, diversified expansion is now the dominant and clearly successful global standard, how quickly do those legacy American and Japanese manufacturing giants, the great corporate structures of the 20th century, how quickly do they need to abandon their slower, more constrained ways?
How fast must they embrace this speed of capital, this speed of technology iteration, to avoid being completely outmaneuvered and left behind?
Because the battle isn't just being fought on the factory floor anymore, is it?
No, it's being thought on the balance sheet in the boardroom,
Yeah.
and it's about this strategic freedom to invest aggressively for the long term, even if it means weathering some short-term storms, without that constant fear of immediate market punishment. That strategic choice, maybe more than any single product feature. That's what seems to be defining the winners in the 21st century.
A lot to think about there. That's all the time we have for this deep dive. Thanks for joining us.
Thanks, everyone.
We'll see you next time.